Hi guys, my name is Radhika Bajaj. You know that age-old saying that too much of anything is bad? Well, you can apply that to all aspects of our lives, including how we invest. Think about it. The mutual fund industry continuously churns out new categories of funds, and the asset management companies then follow up with more new fund offers or NFOs. Last year, from January to October, the industry saw 23 open-ended active NFOs and 46 passive NFOs, and this excludes any debt fund. Consumerism has very much arrived in the financial industry, and that means that as an investor, you have to be very careful and not blindly be influenced by whatever is the hot fund of the moment. Mutual funds are a very important part of investing today. They diversify our holdings, they reduce sectoral risks and help in wealth generation towards our medium as well as long-term financial goals. But here too, having too many mutual funds in your portfolio is not good for your financial health. In this video, we are going to tell you three main reasons why holding too many funds in the portfolio can actually hurt your returns. So let's get started. Now, when you have too many funds with similar objectives and of similar nature, then all you're really doing is creating an expensive index fund. It becomes tough to generate market-beating returns because the loss-making funds negate the profits generated from the good funds in the portfolio. Moreover, when you add the expense ratios of all the funds that you're holding, you create a portfolio that generates mediocre returns while having quite a steep expense ratio. This simply means that the portfolio is getting expensive when you have a lot of funds in your portfolio while your returns from the portfolio actually start to lag. Having too many mutual funds can also make it difficult for you to monitor the performance of your portfolio. Now, as the number of funds bloat, it gets time consuming as well as tiring to review the portfolio. Furthermore, when you become averse to reviewing your portfolio performance, say even once in a year, you turn a blind eye towards funds that are underperforming. And when such funds escape the net of scrutiny, chances are your portfolio will give you subpar returns. Opting for multiple mutual funds when desiring diversification can sometimes lead to diversification. This is because having multiple funds invested in the same group of stocks leads to an overlap in the portfolio. This means that the stocks in these mutual funds are common as well as duplicated. Nowadays, online tools allow you to compare two funds and find out how much overlap is present in any two schemes. Higher the percentage of overlap stocks, less would be the actual diversification in your portfolio, as there would be a common universe of stocks. As we can see here, Kotak Equity Opportunity Fund and SBI Blue Chip Fund have a 41% overlap, meaning that there are common stocks between the funds that do not provide adequate diversification to your portfolio. Moreover, overlapping would result in your portfolio tilting towards a particular style or strategy or market cap. For example, excessive large caps, mid caps, or value funds may result in the bulk of your portfolio going down at once when either of them falls out of favor in the market. And thus, this overlapping or duplication of stocks in your portfolio is a huge unseen risk that you carry when invested in too many funds. It is true that when it comes to equity mutual funds, we are spoiled for choices. However, when we have a financial plan, mutual funds can be the best play for attaining financial goals. Thus, it is essential for an investor to have goal-based financial planning wherein the mutual funds in your portfolios are attached to a particular goal based on the risk profile and the time frame to achieve that goal. This is why more than increasing the number of funds, it is the mix in style or the strategy that will fulfill your financial dreams and generate wealth for you. Remember, investing in small amounts in too many schemes will not help you achieve diversification nor generate wealth in the long term. There is no right number of funds that you must have in your portfolio, but there is a right strategy. So get your financial plan in order and then go ahead and look for the right mix of funds or strategy to achieve your financial goals. Happy investing. Thanks for joining today.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.